It was a fairy tale ending to Disney's fourth quarter. The company reported a steady rise in new subscribers to Disney Plus, dispelling fears that the streaming video boom was running out. The company earned $1.6 a share in the fourth quarter, far higher than Wall Street's estimate of 63 cents and up from 32 cents a year ago. The entertainment giant also reported a strong rebound from coronavirus pandemic lows at its theme parks and resorts. The company's shares rose 8% in after-hours trading after Disney's chief executive said it was on track to meet subscriber targets by 2024. Investors have grown concerned that the streaming market is starting to plateau after rapid growth during the pandemic. Rival Netflix, for instance, posted disappointing numbers last month and warned that subscriber growth would slow substantially in early 2022. For more on this now, joining us is Victoria Scholar, Head of Investment at Interactive Investor. Many thanks for being with us this morning. Victoria, first of all, what is Disney doing differently? I mean, investors have really been worried about the end of this streaming frenzy. Disney has eased these concerns, but how?
Hey there. Yeah, so Disney has been pouring billions of dollars into making Disney Plus a viable competitor to Netflix. Lucky it has some incredible content like Star Wars, The Bounty Hunter, Hawkeye, and the Marvel superhero Encanto, Pam and Tommy, and others. And while Netflix saw a slowdown in its subscriber numbers, which prompted concerns, like you say, about a broader slowdown post-pandemic as everything reopens, perhaps streaming demand would go down, Disney has actually proven that this is not the case. Its quarterly subscriber numbers came in at nearly 12 million. That compares to Netflix, which got just over 8 million. So a significantly larger amount there. And it looks as though Disney is trying to play catch up. It's got some very aggressive targets in the pipeline. It wants to reach around 230 to 260 million Disney Plus subscribers by 2024. And that could potentially see Disney overtake Netflix. But that requires almost 100% growth in its subscribers between now and then. So really, really aggressive targets. But Disney's been very clever in terms of offering an attractive price point on bundle services, including Hulu and ESPN. And it's also got such great content and that sky-high investment that makes it a winning combination.
Yeah, interesting that you mentioned ESPN, but also we saw the rebound in its theme parks and resorts as well. At the same time, I mean, the company is still experiencing disruptions to its pipeline in terms of new TV shows and programs. The domestic box office is not fully recovered from the pandemic. With these companies, I mean, when do you expect a normalization to take place? Or rather, do you think these companies should shift their business models in a way?
Well, we're coming out of the global pandemic, which of course is an unprecedented situation. So it's hard to try and compare it to any examples in history. But what we know is that COVID-19 has accelerated this shift that was already underway amid a decline in cinemas and a rise in online streaming. And this is why we've seen some box office disappointments in the latest quarter, with unit sales in that division coming in at nearly $100 million, disappointing ticket sales for West Side Story and The Last Duel, for example. I think that judging by the share price reaction, though, investors are not too worried about the decline in box office takings, given the rapid rise that's offset that in terms of the gain that it's seen across streaming. So it's more a symbol of this shift that we're seeing in the way that we consume movies and TV series. Unfortunately, Disney has positioned itself perfectly for growth in more modern means of video consumption.
Interesting. We'll see what the stock does at the open today. Victoria Scholar, many thanks for being with us today.